Welcome to the world of global payments and the big issues shaping this industry. You're listening to Commonwealth Bank's Global Payments Series with me, Carli Renzi, Managing Director of Institutional Client Coverage at CBA. As Australia's largest bank, CBA has been at the forefront of exploring how blockchain technology and digital assets, such as central bank digital currencies, can transform the way we move money. In today's episode, we'll dive into CBA's research in this space and explore how tokenised money could unlock new possibilities for payments. Joining me is Sophie Gilder, General Manager for Blockchain and Digital Assets at CBA, to help us unpack what's happening in this fast-evolving space. Welcome, Sophie.
Thanks, Carli. Great to be here.
CBA recently announced a collaboration with the Reserve Bank of Australia and JP Morgan to trial digital currencies in tokenised funding markets. Can you walk us through the significance of this initiative and what it means for the future of digital currencies in Australia?
We think this project's really important. The RBA believes that tokenisation could deliver $17 billion per annum in savings to the Australian economy. Project Acacia is really exploring how digital currencies can support future tokenised markets. You might have heard that there's over 130 countries which are exploring CBDCs, but Project Acacia actually goes further than that. It's not just about CBDCs, it also includes deposit tokens and stablecoins. It's also a great example of collaboration. All our key regulators are observing, and the participants include startups all the way up to large banks and global players. Our use case is focused on the strategically important and growing $350 billion repo market. We're asking, how might the use of digital currencies and tokenised bonds improve the efficiency of this market? And we'll be deploying both wholesale CBDC and deposit tokens. We're bringing critical players together because we want to catalyse change. Infrastructure providers, technology providers, and market participants really need to collaborate in order to realise the benefits of this massive technological change. Tokenisation isn't a new concept, but the change so far has been relatively slow. Our hypothesis is that speed and collateral management will both be improved. And this will be through a combination of tokenisation, digital currencies, atomic settlement, and 24/7 availability. Watch this space because we will be publishing a report at the end of the project.
Exciting. So how do deposit tokens improve upon existing payment mechanics, particularly in institutional settings? Do they differ from stablecoins in terms of functionality and regulatory treatment?
I like to think of it this way. Stablecoins are digital cash. They're fast, flexible, and freely transferable. Deposit tokens are a bank liability. They're regulated, trusted, interest-bearing, but they have smart contract superpowers. Stablecoins have huge potential, but it's still early days. We still need to solve for infrastructure, liquidity, and standardisation before they can really reach their full potential. Regulatory clarity, which is evolving, will drive additional growth and adoption, but we don't think that they'll just replace commercial bank money. There's something really important that stablecoins can't do. Commercial bank money, which underpins about 80% of our economy, enables growth via the multiplier effect. But it is true that commercial bank money needs an upgrade. Deposit tokens will give commercial bank money that upgrade. So effectively, it's like providing them with functional parity with digital assets. By 2030, we expect to see that the volume of stablecoins will have increased, more banks will be supporting them, but we also expect that there'll be the parallel existence of deposit tokens.
There's a lot of hype in the market, and our correspondent banking partners probably want to hear a little bit about some of the misconceptions around stablecoins and deposit tokens. Can you help us some of the common myths and clarify what institutions should know when evaluating these digital instruments?
Some of the stablecoin hype is understandable. They now have a market capitalisation of $270 billion and growing fast, and the transaction volume is $28 trillion, which is actually greater than the Visa and MasterCard transaction volume combined. But there are some misconceptions, as you say. One of them is around this transaction volume. Of that $28 trillion, only about $6 trillion of it is real value moved. The remainder is trading bot activity, automated market making, and arbitrage operations. Another thing that I always hear is stablecoins are a payment rail. Well, yes, they're very good at transferring value, but they're more than that. They're also a store of value, and they're a form of programmable money. You can also lock them up and earn yield, for example, in a DeFi lending protocol. One question I'm always asked is, are they cheaper and faster? If you're using stablecoins for an end-to-end transfer on a very fast and cheap network, then they can definitely move value near instantly and nearly free. But if you need an off-ramp to fiat, a so-called stablecoin sandwich where you go from fiat to stablecoin to fiat, then the more correct answer is maybe. I think that the real innovation of digital money goes beyond making payments faster. It's about making money smarter.
Thanks for that, Sophie. So CBA is recognised globally for its maturity in AI adoption. And at our last results, we announced a partnership with OpenAI. How is artificial intelligence being used to enhance blockchain initiatives and digital asset strategies within this bank?
At CBA, the use of AI tools is an unlock. We're creating entirely new products that didn't exist 18 months ago using new ways of working. Within my team, and we've got a cross-functional team, different staff use AI tools in different ways to enhance productivity on a daily basis. Our strategy folk are researching, drafting, generating, stress testing ideas. Meanwhile, our engineers are using AI tools for prototyping, coding, testing, documentation, and bug fixes. We can now do more in less time, so we're able to take on additional projects, and then we can learn even faster. On the product design front, we're using AI as an integral part of new product designs. A current experiment that we're undertaking, for example, uses agentic AI to automate digital asset transactions, with an agent able to evaluate on and off-chain activity, decide, and then automate decisions 24/7 within the set guidelines. It's an incredibly exciting time to be building new products with a whole world of possibilities that didn't exist a few years ago. It's moving fast, so we're making sure we move fast too.
Okay, Sophie, we're going to close with some rapid-fire questions here. First time you heard the word blockchain, what was your reaction?
That sounds cool. Tell me more.
Finish this sentence. In 5 years, money will be...
Faster, smarter, programmable, and composable.
Last one. Is tokenisation a net positive for international payments?
Yes.
That was a quick one. Thank you, Sophie. Appreciate your insights today, and thanks for your time. You've been hearing from Sophie Gilder, General Manager for Blockchain and Digital Assets at CBA. Thank you for listening. Tune in again to hear more insights from CBA's experts on the world of global payments and moments that matter for our clients.
Things you should know. Guests featured in this podcast are speaking from their personal experiences only. As this podcast has been prepared without considering your objectives, financial situation, or needs, you should, before acting on the content, consider its appropriateness to your circumstances. CommBank does not necessarily endorse the views of a particular individual or guarantee the accuracy of the information provided.